Welcome to the Redpath Nichols Weekly Tax Update Podcast. Last week, I told you that Ian would join us soon, and here he is, the illustrious Professor Redpath.
Here I am, right.
We have 5 things to talk about this week. It was actually sort of a slow week. Let's make sure we can advance them. Here's our disclaimer. This is produced to provide current information about developments in United States tax law. You should check with authoritative sources before you do anything based on our advice here. Our commentary is necessarily brief, and we both rely on tax analysts and Checkpoint published guidance for our ideas, and we acknowledge that in this program every week. Here's what's in this week's program. We learned that compliance initiatives are going to target taxpayers with high balances due. I was surprised. I didn't understand that interest accrues on a self-dealing loan by a private foundation even during closed years. So the IRS can collect the interest even though they can't collect the tax. Fascinating journey into the dark corners of tax law. And then Medicaid in-home care payments, even to a parent, can be subject to employment taxes unless you claim a specific exemption. Questions about the new relief for correcting foot faults, and I know Ian probably wants to comment on this as we get into the item, and I'm certain that he's going to take the ball on cryptocurrency questions because he's our resident expert on what in the world is a hard fork and how does it apply to my money, right?
Well, I don't think we're going to have a whole lot of time to get into that one today, but we're going to have a program on our team tax that they can watch for on the cryptocurrency and virtual currency, whole segment.
And that's team tax coming up on December the 15th. But before then, please join us at Fall Fest. Ian and I will both be speaking at Fall Fest on November 17th and 18th. Okay. Here, comments reported from the UCLA Tax Controversy Institute, a speech by an IRS executive. Research analysts and data scientists are using technology to identify the best cases to pursue. They're using artificial intelligence to target audit, to find audit targets. They've increased their collection in the audit function threefold by using these techniques, and that assisted collection function is going to be expanded in 2023 to focus on emerging issues in real time and concentrate on high-income taxpayers. That will change your focus in how you deal with and how you explain the tax law's operation to your high-income clients. What should they expect?
Yeah, I also think, Lynn, that in that regard, one of the things that we really need to be careful of, and if people haven't been following it, there's been some changes. There's subtle changes. They seem subtle, but they're not so subtle if you think about what the IRS is doing, and that is on the K1 of the 1065 for partnerships. And what's been happening is, in 2020, they put forth that, from now on, you must keep report on the K1. You are reporting the capital account on a tax basis. And then they added language in and a new items in there for pre-contribution gain or 704C gain. Do you have it? Has this partner contributed any property that has 704C gain? And then the next question says, if yes, how much is left of that pre-contribution gain? Mm-hmm. And then if there's a 743 adjustment, there's been a 754 election, and there's been, for example, a death or a transfer of an interest, and 743 applies, they've actually added codes. But then they put this thing in box 20, we have to report what is left of that person's adjustment. How does it apply? What property does it apply to? So you wonder, why are they doing all of this? Well, it's exactly our last bullet point is they're using AI to identify audit targets in the partnership realm. And this has been a high priority item for the IRS now. So we can be expecting a lot more clients. So they're saying, well, wait a second, you have a negative capital account and you had all these distributions. Well, wait a second, did you have basis? Well, yeah, but you have to add back the liabilities. Well, yes, but you have to report those liabilities, that person's share. There was a sale of property, and oh, by the way, you didn't allocate the gain to this partner on 704C. Well, now you're going to report what's available in 704C and how that's being allocated among the partners. Is it existing property that is going to be being depreciated? Well, are you following the regs on how that depreciation is being allocated from that property? So all of this, Lynn, is part of this last bullet point there. It's not just a high income, it's partnerships. And we really need to start being careful because there is so much audit activity. And the IRS says, going forward, this is a priority. But those subtle changes that have been coming over the last few years to the K-1 are specifically so AI can be used to identify potential audit targets with high income probabilities.
Your point, as I take it, is that we as practitioners, preparers of tax returns, need to be alert for these kinds of changes and then alert our clients for the need for proper record keeping and proper reporting.
And I think it also tells us, Lynn, that things that we never thought we had to do and we haven't done in the past, suddenly we have to be keeping track of these things and reporting them, like the 704C pre-contribution gain. We're going to be asked what that number is. What's left of that 743 adjustment, and how do you calculate it? Well, we never thought about having to attach a statement for that.
Before we get completely lost in the partnership, we're going to do that. There is a segment in Team Tax which deals with exactly these kinds of things. Let's get this one. This is, by the way, something that I would not have thought that I needed to keep the records. Interest accrues from the date there is a loan to a disqualified person until that is repaid. And even though the statute might run, like the IRS doesn't catch it in time, and the statute runs on the penalty and the 200% penalty, they can still collect the interest on 250% of the amount of the loan to the disqualified person from the disqualified person, and close to the interest on 100% of the balance from a manager. I had not paid a lot of attention to this, but any practitioner that has private foundations in the client list should be alert for the possibility of a loan to a disqualified person. The confiscatory penalties that apply, it's a 50% penalty if you catch it, and it's 200% if you don't catch it and fix it, which is pretty serious. But the interest accrues from day one.
Yeah, well, what they're saying here, Lynn, is really something that is not always looked at. Is, you know, you had in this particular case that they're talking about, there was a loan, there was no interest ever charged, and it doesn't matter if the interest was in the document that it said, you know, 5% interest or whatever. They never collected interest from the disqualified person. So now the statute has run on some of the years. So some of the years are closed. And the taxpayer kind of wants to say, well, the act of self-dealing was when the loan was made, and then we're done, we're out, we're clear. And what really, there's two parts of this, what the IRS is saying here. One, they're saying every year that that loan is still outstanding is a new, it's a new act of self-dealing. So the statute starts anew on the self-dealing aspect. So yeah, the closed years they can't go after, but the first day of the year, it's a new act of self-dealing. And secondly, in determining the amounts of the penalties, we add the unpaid interest at the beginning of the year and say, okay, you have accrued interest. that becomes part of the principle of the loan, which is now self-dealing. So the act of self-dealing is greater, which increases the penalties. So no, we can't collect the penalty from those closed years, but it's accumulating every year and adding to the penalties in the open years.
You're exactly right. There will be two parts to what the IRS is going to collect. This legal memorandum only addressed whether the interest accruing during the closed years would be collectible. It was a foregone conclusion that the loan to a disqualified person rolled over, and it was a disqualified event in the current year anyway. So IRS was going to collect both. I thought I would throw in, anytime I read something that refers to code sections technically, Code Section 4941 defines self-dealing by individuals and private foundations, imposes 2 levels of tax on the self-dealer and the foundation manager. Level 1, the initial tax is just 10%. Level 2, the additional tax is 200%. Section 6501, once you get past those initial taxes, the general rule is that the amount of any tax imposed will be assessed within 3 years. So the tax had to be assessed within 3 years, but it was reassessed on a rolling basis. Ian is exactly right. Employment taxes are due, and we don't run into this in my practice. I don't have any parents who are in-home service providers. This is really where the rubber meets the road on this. I don't think this should apply, or it does apply with any technical issues for someone who's not a parent. They're not a parent. They're a service provider. They're getting payments from the Medicaid waiver program. Those are going to be subject to payroll taxes. But if they're made to parents, they can be excluded from gross income as a difficulty of care payment. Good, so far. You've excluded the payment, but here we come. They're still subject to FICA and FUTA. And so yeah. I had the reference, Ian, and I had to look it up. I went to frequently asked questions number 15 through 20 at the IRS website. I looked up certain Medicaid waiver payments may be excludable from income, and there it was, big as Dallas. 1 through 14 are questions from individual care providers. 15 through 20 are questions from certified Medicaid provider agencies. Now they are paying people who are paid as employees. And the question is, are they subject to FICA and FUTA? And the answer is yes. So that settles that one. And I thought I would get the definition of section 6051 since we referred to it. That's every person who withholds tax or should have withheld tax. You owe the trust fund tax, whether you withheld it or not. You were responsible for withholding it. It's that simple, and yet some taxpayers make it that complicated. The mulligan that is
one last thing, Lynn, before we go past that, is another aspect of that has to be watched out for that is mentioned in here is even if the payment is not subject to tax under section 131 of the code and is one of these disability these payments for additional care, it doesn't mean it's not subject to FICA and FUTA.
Exactly.
They said those are two different things. So even though it may not be subject to income tax, it may still be subject to FICA and FUTA. So they said, watch out for that one, that you think it's exempt because it's not subject to income tax because you found an exclusion. They said two different things.
And we have this problem, frequently have this problem with relatives, parents who care for the child, making sure that we get it classified as a difficulty of care payment, which is an exception to the requirement to withhold. And it is a complex area of the law, but that's what we deal with. That's what we get the big bucks for, right? Okay.
But it's something, as we said, we have to, you should look at it if you have this situation, and remember there's two different sides of it, the employment tax side and the income tax side. So you got to look to both.
Speaking of complex areas of the law, in Revenue Procedure 2022-19, the IRS finally left the field and is going to allow us to use self-help in straightening out difficulties with our S elections and LLC conversions, and they have 6 procedural missteps which can be corrected by the taxpayer if the taxpayer follows the procedures that are laid out in RevProc 2022-19. To be eligible for this relief, the entity must satisfy 4 requirements. It has or had one or more non-identical governing provisions. It timely filed a Form 1120S before any provision is discovered by the IRS. The entity and its shareholders complete the corrective relief statements. So you got to be ahead of the IRS. So 1, 2, 3, 4, if you have all those things. The problem is with number 2, it can happen with disproportionate distributions that are deemed. It can happen with excessive compensation. It can happen with compensation implied in a below market loan. So the IRS has been asked by our professional lobbying agency, the AICPA, to take another look at number 2 in this list to see if we can't come up with a better solution, because so many S corporations will not qualify for the intended relief because there are disproportionate distributions. And that brings us.
Just one more comment on that is that the biggest area where you're going to see this is those so-called non-identical provisions, where you've converted, for example, an LLC into an S corp, or a partnership into an S corp, and you still have the same basic operating agreement, and that operating agreement essentially can be interpreted to allow, even if you don't have them, the document allows for disproportionate distributions or allocations that are not proportionate. Just the fact it's in your document is enough to say you have a second class of stock. But what this is saying is, hey, no, we understand this. We understand that some documents are not even artfully written. As long as we haven't caught you, the relief is going to be there for you. So basically, you can go ahead, and there's 2 statements in the RevProc. One is a statement by the shareholder and what the shareholders or shareholder affected, and the other is the corporation. You fill them out, you sign them under penalties of perjury, and at least from the RevProc, it appears that you just keep them in your records, and if they ever audit you, you go, oh, no, we corrected everything, and you're fine. They're trying to eliminate this constant barrage of private letter rulings asking for inadvertent termination relief.
And by the way, in Team Tax, this segment, I'm doing a 50-minute segment on this very thing in Team Tax, and we will cover the standard wording, the 2 documents, the standard documents that are included with this revenue procedure. So let me get you to your long suit here, I think. Virtual currency replaced by the word virtual currency. Do words matter? That's the question, right? So I took my snipping tool and I snipped out this piece of the 2022 Form 1040, page 1. There it is. At any time during 2022, did you receive or sell, exchange, gift, or otherwise dispose of a digital asset or a financial interest in a digital asset? And then you referred to the instructions. It's a simple question.
Well, you used your clipper went too far in, because one of the things is just before this, in the margin, they use the term digital asset. Now in the prior years, it's virtual currency. So now they're using a different term than we have used since 2018.
It's right there.
Virtual currency, digital assets. Are they the same? Are they not? Are non-fungible tokens
Wait a second.
digital assets? What's the definition? This is a huge issue.
I see the words digital asset right there. Dispose of a digital asset.
And guess what? The digital asset, the definition is in the Infrastructure Act. They define it, and it says basically what we think of value showing value electronically, digitally, or anything else is determined by the Internal Revenue Service by future regulations. Well, I don't know what that means. And so by changing the terminology, they've kind of got us out there in a, what does this mean? Because it can include other things that are not in the concept of the definition of virtual currency. The other problem, Lynn, here is that even the definition of virtual currency in the instructions for 2021 contradicts the definition that they use in two different revenue procedures. So essentially, even the IRS is giving us different definitions. How different? Well, in one position, they use an or and an and. Well, or means any one of these, and means it has to have all three. The difference is non-fungible tokens under the definition in the RevProx would be considered a digital asset, but not in the definition they give in the instructions. So what does this mean? Hold on for future. We're going to do another program on this, and I'm doing a program in the team tax on this, because this is a huge area to sit down with your clients right now. We got to change the questions and get ahead of this before the IRS does. And this is where they're heading. They're just kind of leaving us out in the dark. So we got to start asking more questions of our clients so we can hopefully get more guidance between now and when the returns are due.
This issue is sufficiently hot. Before we leave the program, I want to make sure that everyone is well informed. Ian is our go-to guy on virtual currency digital assets. He will be joining me on Thursday for a short commentary on this topic in Nichols Knowledge Nuggets, which expands on topics we can't expand on in the podcast. Then please join us for Fall Fest in Columbia, November 17th and 18th, I believe.
17th, 18th.
And Ian has promised that he will update us on virtual currency and digital assets in Team Tax on December 15th. So coming attractions, Ian and I will be double teaming this weekly podcast. If you have questions, concerns that are not covered in the give and take on SCAPA's website, please send them, and we'll do our best to address them here. Ian, a parting shot?
No, this was really full of some very important things today. But like you said, these are the teasers. All of the major things we talked about today are going to be addressed in different programs, either in the Team Tax or in the Fall Fest. So
tune in.
We'll expand it.